problem is an excellent integration of both the dividend discount model, for which we will use and solve the final answer of how much the stock should price for today, as well as integrating the Gordon constant growth model in order to be able to estimate a future price based off of a constant growth assumption. So the dividend discount model is ostensibly us just determining the sum of total present values. So let's look at what the cash flows are likely to be. So Integrated Potato Chips just paid a $1 per share dividend. I'm going to label that -1. And the reason being is the idea of paid, meaning they did it already. It's not a cash flow that an investor would get next because it happened already, past tense. And you expect that dividend to grow steadily at 4%. Knowing those two things then, the first thing that it would like us to do is project the dividends for each of the next 3 years. So let's put in our periods in here. I always like to put period 0 into that first year. And you'll see that I'm actually going to go out to year 4 for the time being, although what it's asking is to project the dividends. So if it was $1, it would grow by 4% rate, which means 4 cents. If we added back that original $1, you'd see $1.04. Let's do that now in cell B14 a little more efficiently, which is to say, let's take the previous amount, multiply it 1 plus the interest rate, which we'll fix so that we can guess and answer. The first 3 dividends are likely to be $1.04, $1.08, $1.12. So there's our answer for number 1. Question number 2, if the discount rate for the stock is 12%, at what price will it sell? Well, it's asking us for the price right now, and here's what it's told us that we need to know. In addition, sorry, I'm trying to get my subscript in there and I'm missing. I made the whole thing a subscript, which was a little bit more than we were trying. All right, with a rate then, it said was equal to 12%. So with a rate of 12%, at what price will it sell right now? So the price right now would be equal to the next dividend divided by rate minus growth. So if we execute that formula in here, if right now our next dividend would be $1.04 divided by then the discount rate of 12, subtract off the growth rate of 4, and that suggests that the price right now would be at $13. Now, what is the expected price of the stock 3 years from now? So I'm going to go ahead and label this P3, suggesting that we're trying to calculate the price of the stock 3 years out. So what we're really talking about is how much would it sell for right now at the end of the 3rd year. Well, what do we know at the end of the 3rd year? We're now looking into the future. The $1.12 would have been the one that was paid in the 3rd year. So the next dividend would be the $1.17 that would be paid in the next period, because in period 3, div 1 would be the dividend for period 4. So that forward price would be dividend 1, assuming that the growth rate is still 4%, and with a rate of 12%, suggests that the forward price would be dividend 1 divided by rate minus growth. So you get a $14.62 future price. D, if you buy the stock and plan to sell it 3 years from now, what are your expected cash flows in year 1, year 2, and year 3? So now we're starting to put together what's really a present valuation model where we are looking at the same periods that I have up above, periods 1, 2, 3, and 4, and it's asking us what are the cash flows you would get in. The first cash flows you would get would be those dividends. Then the next cash flow you would get in would be on the sale of the stock at the end of the third year, pardon me. The fourth year, we would not get anything. So instead, we would only look at 3 years. If we wanted to, we could total this up and suggest that the cash flows we would get in total then would be equal to both the amount that we receive cash flows in for dividends as well as cash flows in upon sale. With that in mind, then, it asks, what is the present value of the stream of payments you found in part one? So like we have done previously, then, let's use those cash flows to calculate what is the present value if at a rate that won't change. So we put the dollar signs or F4 on an APC, when right now you would get no payment but a future value of $1. And how would that apply to the next period? At a rate of 12%, 1 period away, if you receive just the dividend, because you're not selling yet, of $1.04, you'd be willing to pay the 93 cents, and etc., copy and pasting until in the end, what we see is the present value at a rate of 12%, 3 years out from now. We're discounting the total amount of the cash flows, where the total is equal to both the cash flows that you would get from dividends as well as the cash flows in that you would get from the sale. So if you put that all together as price, and I'm going to change the sign on it just so it doesn't present as a negative, and we add it up, and magically what we see is that whether you use the Gordon constant growth model to estimate what the prices should be right now, or if you were to use the dividend discount model, whereby you project out the cash flows that you would get in from dividends, you project out the cash flows that you would get from sale, you discount those by a required rate of return over the periods in which the cash would actually flow. What you eventually would wind up with then would be the sum total of them, so that the price right now, in either way you calculate it, would be $13. I'll finish typing that off, make it into a nice subscript, and there you have a problem that combines both the dividend discount model, as shown down here, with the Gordon constant growth model, as was demonstrated there.